Canadian banks are facing a significant challenge. With their cash reserves, and the issue has drawn attention across the country. To help ease the situation, the Bank of Canada has stepped in by lending an astounding $16 billion per day to support these banks. This raises important questions. Why do these banks need such help, and what does this mean for the average Canadian who has their money stored in these institutions? To understand this, we first need to explore a concept that may seem complex at the first, but is actually quite straightforward. Quantitative easing, shortened for QE. If you've never heard of it, QE is a strategy central banks use during tough economic times. Essentially, when the government needs money to keep the country running, it issues bonds, sort of IOUs. Big institutions like banks buy these bonds, which means the government agrees to pay them back with interest at a future date. During the pandemic, something extraordinary happened. Normally, it's the banks and large financial institutes that buy these bonds. However, the Bank of Canada took things into their own hands by purchasing hundreds of billions of dollars worth of government bonds. Why? To keep interest rates low and the economy afloat. This strategy was critical at that time when the economy was struggling to survive the impact of the pandemic. Now you might be wondering, where did the Bank of Canada get all that money to buy these bonds? The answer is the Bank of Canada essentially created money out of thin air. They didn't physically print bills, but through a few digital keystrokes, they added funds to the balance sheet. This new money is known as a settlement balance, and it's one of the key tools used in quantitative easing. So when you hear that QE, it's basically the Bank of Canada injecting new money into the economy by purchasing government debt. While QE might have helped Canada avoid an even more severe economic downturn, during the pandemic, it's important to recognize that this approach was some serious side effects. For one, by flooding the system with extra cash, QE tends to drive up asset prices. This means, like stocks, real estate, assets typically owned by wealthier Canadians to go up in value. Unfortunately, most average Canadians don't own significant amounts of these assets, so they don't benefit from these price surges. Meanwhile, QE can also contribute to a rise of inflation, which leads to higher prices for goods as well as services, affecting everyone. But the QE isn't the whole story. On the other side of the coin, there's a process called quantitative tightening, or QT. Quantitative tightening is essentially the opposite of QE. It pulls money out of financial systems. Over the past 2 years, the Bank of Canada has been doing exactly that, withdrawing hundreds of billions of dollars from circulation. While this is part of their plan to control inflation, it's causing new problems, particularly for the country's largest banks. As QT continues, these issues have become harder to ignore. Some of Canada's biggest financial institutes are starting to feel the pressure, and the Bank of Canada is stepping in once again, this time to prevent things from getting even worse. But why these banks running into trouble? And what exactly is the Bank of Canada doing to help? The Bank of Canada and the trouble with cash reserves. After realizing that inflation wasn't just a temporary issue, something they initially thought would pass on to its own, Bank of Canada made two big moves in 2022. First, they raised interest rates faster than we've seen in recent memory. And second, they began pulling money out of the system through QT, letting the bonds they bought during the pandemic gradually expire without buying new ones. This means the government has to issue new debt to replace the old. But this time, instead of the Bank of Canada buying the bonds, other buyers like big banks had to step in. Here's where things start to get complicated. These big banks are buying up huge amounts of government bonds, but this takes a lot of money. In fact, the banks are betting the bond prices will go up as interest rates come down. which gives them an incentive to spend even more on bonds. To, to do this, though, they need cash, and a lot of it. The tricky part is that the banks are not only spending vast amounts of cash on bonds, but they're also having to keep a certain amount of cash on hand. According to regulations, this is known as a capital reserve requirement, and it's a safeguard to ensure the banks can always give people their money when they need it. So even though the banks are pouring their money into bonds, they still need enough cash in reserve to meet these requirements. But some banks are finding it hard to balance these competing demands. To solve this, the banks typically rely on what's called the overnight repo market. This is a system where banks lend cash to each other overnight to make sure that they meet the cash requirements. However, in recent months, something unusual has been happening. Some banks are choosing to hold on to their cash instead of lending it out to other banks. This has created a shortage of available cash in the system, making it even more difficult for banks to meet their reserve requirements. At this point, the Bank of Canada has no choice but to step in as a lender of last resort. This means they're offering short-term loans to banks that need extra cash to keep their operations running smoothly. Without the intervention, some banks might not have enough cash on hand to continue functioning properly and could lead to much bigger problems. Recently, the Bank of Canada has increased the limits on how much they're willing to lend to banks each day. Initially, they were lending $5 billion per day with a cap of $1 billion per bank. However, they are now raising the limit to $16 billion per day, with individual banks allowed to borrow up to $3 billion. This massive increase in lending is designed to ensure the banks can meet the cash needs despite the challenges they're currently facing. But why are some banks hoarding cash? One possible explanation is these banks prefer to keep their cash reserves high so they can issue more loans like mortgages, higher interest rates. After all, why lend money to a competitor at a lower rate when you can hold on to it and make more profit by using loans to your own customers? So what does all of this mean to you and me? Should we be worried about the stability of the banking system? The good news is that most people, there is no immediate cause of concern. The Bank of Canada is doing what it needs to keep doing, things running smoothly and the bank system remaining secure, at least for now. However, there are still questions about what will happen in the long run. Will these interventions prevent a major financial crisis, or are they simply delaying the inevitable crash? It's hard to say for sure, but for now, the system is holding up and the Bank of Canada's actions are keeping things stable. Don't forget to like this video. I'm curious, what do you think about all of this? Do you feel confident in the banks, or are you considering alternative ways to protect your money? Let me know your thoughts in the comments below. Thanks for watching, and I hope this video has helped shed some light on what's going on with the Canadian banking system.